Hi everyone, and welcome to today's lecture. This is Anne from TEJ. Today we're going to talk about credit risk of Chinese listed companies and how to use credit risk quantitative model, which developed by TEJ to assess credit risk for Chinese markets. Next, let's just walk through our outline. First, I'll start from the current risk profile of the Chinese market and TEJ's approach to analyze credit risk in the Chinese market. Finally, also share a few cases of default that TEJ has successfully provided early warning signals for credit risk. This talk will provide a preliminary understanding of credit risk in the Chinese market and the approaches how to analyze and prevent them. First of all, let's take a look at the current risk profile of the Chinese market. Usually, rating from China's local credit rating agencies is most commonly used for credit risk assessment. According to statistics released by NACME, which is in charge of Chinese bonds development, by September 30, 2020, most of listed companies' corporate ratings and bond ratings fall within the range of AA and AA+, which indicates China local rating agencies believe that rating companies and bonds is under a relatively stable condition. But is this really the case? Based on a recent report by China Times, 432 companies have switched their auditors, and 32 companies have been issued disclaimers according to 2020 annual report. And we must understand that both auditor switching and disclaimers, especially the latter one, indicate the company has a great risk, with management and financial problems behind. Furthermore, according to Securities Daily, by May 5th this year, a total of 66 listed companies have been warned of delisting risk, as known as special treatment. Based on these two pieces of news, it points out there is an information asymmetry between actual financial markets and rating agencies. Since the professional rating agencies cannot provide an accurate warnings of companies' credit risks, is there any way to predict credit risks? In fact, our quantitative risk model, CCRQM, has successfully provided early warning signals for the most of credit risks. Next, I'll give a brief explanation on how CCRQM works. As we know for traditional credit rating, rating agencies might avoid a bad credit score since they are paid by the rated companies to do the ratings, which point out the most discussed issue, avoidance of conflict of interest. In contrast, our CCRQM is an early warning system that is completely controlled by a quantitative model. Our rating coverage contains all listed companies in Shanghai and Shenzhen Stock Exchange, and we transform companies' public information, such as financial reports, into a high-quality database. By rigorous methodology and long-term testing and tracking, our model can rate the listed companies in a relatively fair and objective way than traditional credit rating. Apart from basic financial statements, we also take some vital factors for credit risk into consideration, such as the company's proportion of products sold, and the operating conditions of subsidiaries, the transaction with related parties, and the company's shareholder structures and the status of employee. In addition to information from financial statements, major events occurred during the open window period cannot be ignored. Also, according to our experience in the past, the company's prompt rising status and whether it has made a forecasting performance and performance commitments are also closely related to its risks. Furthermore, apart from companies' own operational financial information, we also look at the market's performance to see if the stock price has risen and fallen sharply. And also, we'll take market participants' idea into consideration by observing the transfer and pledging of major shareholders, and the comments from funds and legal entities. After considering the above information and cross-check the logic and rationality of information, we build our credit risk model. Our CCRQM provides rating score from 1 to 9. The meaning of rating levels is actually quite simple. The higher the levels, the higher the risk, especially level from 7 to 9. It often means that the company has a great instability in operation, finance, or franchise, which might lead to a default at any moment. Therefore, if the company you are dealing with is rated within the range, you must be extra careful and take measures to ensure risk protection. So, how exactly does CCRQM provide rating levels given so much public information? Let's take a look at rating procedure. First, we evaluate 4-dimension risk assessment factors with 8 financial ratios after long-term testing and tracking. Then, with basic score, we could know the company's strengths and weaknesses on different dimensions of risk assessment factors. Second, we will take 3 thresholds into consideration. They are scale, financial window dressing, and group thresholds. Finally, the result will show on CCRQM. And this slide shows the risk assessment factors we used in this model, which are divided into 4 dimensions: profitability, safety, efficiency, and corporate governance. There are many subtle adjustments under long-term testing and tracking in these financial factors. For example, for continually ROE, we replace non-operating income with recurring income, and the guarantee is included in debt divided by equity, because there are cases that Chinese companies often have their own debt clean, but with huge guarantees for subsidiaries. After adjustment by financial factors and several threshold conditions, companies whose risks are difficult to be identified will be further filtered out. Next, I would like to explain on threshold conditions. Threshold conditions are divided into 3 parts. First, the scale threshold is based on revenue, and scale threshold can prevent small companies from direct default when they face systemic risk due to high customer concentration or low revenue. As for threshold of window dressing financial statements, the upper threshold is given by CPA opinion, whether main actual controller's equity pledge ratio is higher than 80%, and special treatment sanctions. And the group threshold is to consider the transfer effect of risk in the same group, and whether if it's state-owned enterprise, given the upper and lower limits of levels respectively. After screening by the comprehensive scoring and thresholds, here is the final result provided by CCRQM. After the previous explanation, someone must be wondering if there is any default cases that TJ has successfully provided early warning signals. The answer is yes. Next, I'll briefly share a few examples. First of all, let's take a look at Meishan Ecology and Landscape. In 2020 annual report, auditors issued a disclaimer to point out that the company is facing operational and financial risks. However, China Galaxy Securities gave Meishan a recommendation rating on February this year. Given the fact that China Galaxy Securities and auditors have very different opinions about the same company within such a short period of time. So, how to prevent this from happening? According to China Lianhe Credit Rating, the company's outlook has remained stable from 2017 to June 2020, and the corporate rating is also maintained at AA. And not until 2021 was the company included in the watch list. In contrast, from the perspective of CCRQM, it is quite obvious that the company has been in troubles and rated as high risk as early as 2017, with downward comprehensive score over the years. Furthermore, based on CCRQM financial factors on our system, Meishan's main problem lies in two aspects: corporate governance and operating efficiency. Since this year, corporate governance risk messages, including transferring major shareholders, resignation of independent directors, and substitution of actual controllers, are all showing the signs of default. Next, let's take a look at next example. Jiangsu Chengxin Fast Chemical has been ranked ninth among private enterprises in Jiangsu in 2020, with revenue used to be as high as 100 billions of yen. However, its headquarters was shut down this March because of 174 million yen of renovation cost. What happened to this company? According to China Lianhe Credit Rating, Jiangsu Chengxin has a stable AA rating until 2015. However, in 2017, Jiangsu Chengxin's subsidiary was subject to administrative penalties, and therefore, China Lianhe Credit Rating issued an announcement to explain the situation. One is that the company failed to disclose related parties' non-operating funds, and the other is that the financial report released in 2011 and 2012 contains false records. China Lianhe Credit Rating obviously failed to provide early warnings since we can only receive the information after reading the announcement or punishment. In contrast, according to CCRQM, Jiangsu Chengxin's comprehensive score has remained negative as early as 2011, with a high risk level 8, so there is no need to wait until 2017 or 2021 to receive warnings of risk. Let's take a look at Kame Pharmaceutical. At the beginning of this example, I would like to explain what is white horse stocks. In China, white horse stocks means the company with open information, little possibility of black box operation, and stable performance. However, financial reporting fraud occurred to Kame Pharmaceutical, which used to be a white horse stock. In 2018, Kame Pharmaceutical announced there were 30 billion extra cash on 2017's balance statement due to accounting errors. However, before the announcement, Kame Pharmaceutical's cash on balance sheet was 34 billion, which means that 88% of cash did not exist. In 2018, when the 2017 financial report was restated, the inventory was recorded as 20 billion yen less. Therefore, at the time of performance correction noticed in 2021, an impairment loss of 20.3 billion yen was written. Though it's impossible to know whether the inventory were undercounted at that time, but the fact is that there is 20 billion less inventory. In this case, CCRQM had already listed the companies as high risk in 2012 because the equity pledge ratio of actual controllers was greater than 80%. After seeing so many examples, we can actually identify high-risk companies based on clues from our risk assessment and thresholds. And CCRQM are integrating these details to further identify the risks that are difficult to detect. In conclusion, we can avoid investing all kinds of risky companies in an effective way when facing the Chinese market. At last, thank you for your time. And if you are interested in CCRQN and require for deeper discussion, please feel free to contact with our team and we'll be in touch with you soon. Thank you for your join again and hope you have a nice day.